In trading and investing, there are many different types of strategies that market participants employ. In this lecture, we will be looking at some of the larger and most important types. The two main types of investing are fundamental and technical analysis. We'll be starting off with fundamental. Fundamental analysis is extremely broad. You could say that fundamental analysis is the cornerstone of investing. The biggest part of fundamental analysis involves delving into company financial statements and looking at different aspects of a company, such as the revenue, assets, expenses, liabilities, etc. This is most definitely geared towards the mathematical side of trading. It involves a wide range of calculations to figure out stock prices in the future. According to Investopedia, fundamental analysis is a technique that attempts to determine a security's value by focusing on underlying factors that affect a company's actual business and its future prospects. Fundamental analysis can be performed on industries or the economy as a whole. So, as opposed to technical analysis, which we will be looking at after, which involves analyzing based on price movements, fundamental analysis goes beyond that and looks at the overall well-being of a company. Some questions a fundamental analyst might ask are, is the company's revenue growing? Is it making profit? Is it able to repay its debt? How does it compare to industry competitors? There are some of the few, but basically you would look at whether the company's stock is a good investment. So, the intrinsic value. Fundamental analysis is based on the concept that the price of a stock does not fully reflect its real value. In the financial world, that real value is called the intrinsic value. So let's take a small example. Say Microsoft is trading at $28 per share. After much analysis, you figure out that its intrinsic value, how much it's really worth, stands at $34 per share. That is 21% higher than its current value. In the eyes of a fundamental analyst, that would present a great buying opportunity, as the stock would be what we would call undervalued. In the opposite case, where the current price is $34, while you find out that it's actually worth $28, you would say that it's overvalued. The largest assumption in fundamental analysis is that in the long run, the stock will always reflect the fundamentals. But no one really knows how long the long run is. It could be a period of days or even years. So that is what fundamental analysis is really about. By focusing on a company or the economy, an investor can determine its intrinsic value and find opportunities to buy or sell. If all goes as planned, the investment should pay off over time as the market catches up to the fundamentals. On the other side of fundamental analysis is technical analysis. Unlike fundamental analysis, technical analysts, or technicians as we would call them, don't care about the value of the company, or the company as a whole. All they really care about is the price movement in the market. They employ lots of fancy and exotic tools to study the supply and demand in a market in order to attempt to determine the direction or trend in the future. Another way of describing them is that they try to understand the emotions of the market by studying the market itself, as opposed to its components, like fundamental analysts do. Technicians evaluate stocks by analyzing the statistics generated by market activity, such as prices and volume. They do not attempt to measure the intrinsic value, but instead use charts and tools to figure out the pattern. Technical analysis is based on three assumptions. Number 1, the market discounts everything. Number 2, price moves in trends. And number 3, history tends to repeat itself. Technical analysts only consider price movements and ignore the fundamental factors of a company. The reason for this is that technicians assume that at any given time, a stock's price reflects everything that has or could affect the company, including the fundamental factors. They believe that the company's fundamentals, as well as market psychology, are priced into the stock. Therefore, there's no need to analyze the company itself. In technical analysis, stock price movements are said to move in trends. That means that when a trend has been located, the future price will move in the same direction as the trend. The last important idea of technical analysis is that history repeats itself. The repetitivity is due to market psychology. Market participants tend to provide a consistent reaction to similar market activities. Technicians use chart patterns to analyze market movements and understand trends. Technical versus fundamental analysis. In a way, you could say that it's like comparing financial statements versus charts. A fundamental analyst tries to determine the intrinsic value of a company by looking at its statements and determining whether it is over or undervalued. Technicians believe analyzing a company's financial statements is redundant, as it is all accounted for in the stock price. Therefore, they place the efficient market hypothesis at the top of their beliefs. Usually, fundamental analysis is used when you're looking towards the long term in a stock, while technical analysis is used for short-term trading. Even though they might seem contrary to each other, they can still both coexist. It can actually give the trader or investor a higher chance of success, as he or she can analyze both the long and short term of a stock. So, this concludes this lecture. Thank you for watching.